In this Hauseit tutorial, we will be showing you how to analyze the financial statements of a condominium. Now, if you're watching this video, you're likely a home buyer. You may even be a real estate agent, broker, salesperson, or you could even be a real estate attorney. The ability to review the financial statements for a condo is a very important skill for all market participants in real estate. And in particular, it's very important to be able to analyze a financial statement, primarily because it will give you an idea of whether or not the building is well run, prudently capitalized, and it will basically give you a preview as to whether or not you would seek to expect any unusually high operating expenses once you've actually purchased a property. If you're a real estate agent, the ability to analyze financials will help give you a bit of an edge versus other agents who may not be able to advise their clients on how to actually analyze a financial statement. It's also worth remembering that in terms of responsibility load during a purchase, a real estate attorney will be the one who conducts ultimate due diligence on a condo prior to a buyer signing a contract. So as a broker or even as a buyer, you certainly can request the financials prior to the accepted offer stage. You can review them yourself, but it's also good to know and remember that a real estate attorney will require the financial statements as well as the offering plan, house rules, and any other building documentation such as the purchase application and sublet application in order to complete due diligence prior to advising their client that it's an appropriate time to sign the contract. So in this video, we're going to walk you through a financial statement. It's a real financial statement for a building here in New York City. And we're going to go through the sections that are important for you as a buyer, as a broker, or even as an attorney. So the first thing you want to do when you open up a financial statement is you want to obviously check the year. Usually attorneys will look for the two most recent years for the purposes of looking at the due diligence materials. So depending on where you are in the calendar year, it is possible that a building may be in the next fiscal year, but they might not necessarily have the financials ready for the one prior. So you may want to be mindful of that. And also when it comes to a mortgage lender, if the building has taken a reasonably long amount of time to actually come up with the most recent year's financial statement, it may be an issue. In this case, we're looking at a historical statement, so I'm not going to go into the details of the calendar, but just keep in mind, make sure you get the two most recent years of financials for you to analyze. So as you scroll down into the financial statements, the first section is going to be, some sort of auditor's report or opening letter. In this case, the financial statement is audited, which means that basically an independent auditor has evaluated the financials and been able to come up with an opinion as to the financial statements themselves. If a financial statement is unaudited, it means that the actual accountant is not preparing and providing any opinion as to what is contained within the financial statements themselves. So when you're looking at audited financial statements, you can obviously start by looking at the various sort of notes in a sense here, and you can read through those, but the most important thing is to look at the actual opinion section. Now, when you're looking at the opinion section, you basically want to be looking for the following phrase: presented fairly in all material respects. This is the green light, which basically means that there are no issues that the auditor has discovered which may be worth mentioning. Now, as a quick aside, if you go onto the Hauseit website, there is an article you can follow along with. It's called Analyzing Condo and Co-op Building Financial Statements in NYC, and it actually goes through all of the points that we're discussing on this video. So in particular, we've started with the opinion letter, and as you can see here, you'll want to look for keywords such as presents fairly, which is a good sign of a healthy set of financials. What you don't want to see are things such as restrictive language, including subject to or except for. So if we go back here, again, we'll see that they've used the phrase present fairly in all material respects. So that's a really good sign as we start our review of the financials. Now, as we scroll down, the next thing we want to look at is usually the balance sheet. Now, the balance sheet is very important, specifically because it will tell us what the current cash holdings are for the condominium. In this case, the condominium has $387,000 in cash and cash equivalents. Now, when we look at that number, we need to analyze it in the context of how long could that amount of cash support the building's operating expenses, right? So if we're looking at a massive condominium with 400 units, and we're looking at another building with 20 units, you can see how the size of this number doesn't necessarily have any realistic meaning behind it if we don't look at the actual expenses. So what we want to do here is we want to quickly jump to the income statement, and we want to find out how much are the building's operating expenses. And once we've done that, ideally we want to do some math and figure out how many months of operating expenses does this cash balance support. And as a general rule of thumb, we are looking for that to be 3 to 6 months. So if we go down into the income statement, specifically under expenses, looks like the expenses are approximately $1 million a year. So if you open up a calculator or an Excel, we're just going to divide that by 12. And it looks like we have approximately $80,000 a month to run the building. So if we go back up to the cash balance, it's $388K. So if we take 388,000 and we divide that by the monthly operating expenses, we convert it back to a number, it looks like we have about 4.5 months of actual operating expenses in terms of the size of our cash position. The next thing we want to look at are the accounts receivable. The accounts receivable is very important because it gives us a general sense for the health of the building. In particular, if the accounts receivable are a massive percentage of our operating costs or of our current assets, it may be an indication that somebody hasn't paid us, somebody hasn't been paying the condo, and there could be some sort of implication there for possible little or no recovery, losses, so on and so forth. So in this case, the accounts receivable is $13,000. Now, relative to a cash balance of $400K more or less, that is an insignificant number. Therefore, there are no issues with the accounts receivable. Now, on the flip side, if we go look at accounts payable, this is another thing that we want to analyze. Now, in theory, the condominium should be paying their bills on time. There really shouldn't be any large accrual for unpaid expenses. And as a general rule of thumb, you really shouldn't have accounts payable that are greater than 10% of the actual income of the building. So in this case, we have $193,000 of accounts payable compared to income revenue of, say, 1.1 million. So it is actually a very large number, and it may very well be concerning, and it would be something that your attorney, if you're a buyer, would possibly inquire about with the managing agent. Now, before you reach out to the managing agent to confirm things, you may also certainly want to look at the notes to the financial statements. So every financial statement will have a notes section, and if you go down here, you may very well find something about the fact that you have large accounts payable. Specifically, there is something mentioned here in note 10. Included in the condominium's accounts payable is $132,000 in water and sewer charges estimated to be due for prior years. They also make some mention of the statute of limitations, and that's really how they've computed this number. So if we go back to the accounts payable and we think about what we just learned, let's take a look here. So of that 193, excluding the water issue, it's about 60K, which relative to $1.2 million of revenue is still under 10%, and that was kind of our threshold. So clearly we found the issue here. There was some problem with the water. Not sure what that is. If we were to venture a guess, perhaps there was some sort of problem with the meter. Maybe the readings weren't working. Maybe the condo was being underbilled, and the DEP, at least in New York City, DEP is probably working on that arrears bill with the condo, and presumably the condo will have to pay out that money in the near future. So moving forward, while we're on the notes, this is the section where you're going to want to look and see if the building has any sort of mortgage or loan exposure. The notes are going to tell you essentially what the interest rate is, what the terms are of the actual possible floating rate, right? When does it reset? And also when does the actual loan need to, or rather, when does it expire? When does it mature? So that's something you're going to want to look at, because if, let's say, the building has a line of credit that's a floating rate and it's reset annually, and in the last year interest rates have gone up astronomically, it would in theory mean that the line item in the income statement for any potential financing interest charges could go up drastically. And if it does, you would want to figure out, is the current level of the condo common charges sufficient to help absorb that increase in financing expense for the building? So in this case, the building doesn't appear to have any sort of mortgages or line of credit or anything, primarily because if we go into the expenses, I believe there's a note to that which tells us about the expenses. There is nothing in here about there being any financing charges. So that being said, the takeaway is the notes to the financial statement are really important. If you discover anything in the financial balance sheet, income statement, statement of cash flows that is confusing or sketchy, the notes are going to be where you can possibly figure out what exactly is going on. Now, going back into the income statement, it's also a good idea to, generally speaking, analyze the composition of the income. So, for example, you want to take note of any specific line item that is a disproportionate size relative to the total revenues. Now, in this case, the revenues, the vast majority of them come from common charges. Now, it's not a problem that the majority of revenues comes from common charges. That's actually a very healthy sign, and that means that the building receives money from the owners, and those substantially basically pay for and account for all of the revenues and consequential expenses in the building. The issue would be if, let's say, under revenues, instead of this line item saying common charges, it said something like flip tax. Now, a flip tax is usually for a co-op, and a flip tax is basically a private transfer tax that the co-op charges sellers. So a seller of a co-op in the city, New York City, has to pay the governmental transfer taxes plus the transfer taxes for the co-op. So if, for example, the majority of the revenues didn't come from the fees the owners paid, but rather they came from a flip tax, it would mean that the building's revenue source is largely dependent on the continued rate of, sellers transacting and selling properties. So if there were a market disruption possibly and the volume of deals slowed in the building, and the majority of the income came from deal and sale related transactions, you could see why it might be an issue. But in this case, the revenue is very sticky. Common charges are the be-all end-all of revenue for a condo. Fortunately, there are a couple of super small items here. They're pretty insignificant relative to total revenues, but nonetheless, it is always important to look at and figure out where is the revenue stream coming from. Another one to take note of is any potential income from a commercial tenant. So if a condominium has some sort of commercial space downstairs and they're receiving rent, that rent is probably sizable, and therefore you want to be very, very aware of when exactly does that commercial tenant's lease come up for renewal, and perhaps even what is the history of that tenant, right? So prior to that tenant, or how long have they been there? Prior to that tenant, was that space vacant? How long was it vacant for? So on and so forth. So we've talked about most of the statements now. We've talked about the balance sheet. We've talked a little bit about the actual statement of revenues and expenses, also known as the income statement, we may also want to look at the statement of cash flows. So the goal of analyzing the statement of cash flows is really just to make sure that there is a positive net cash flow for the building. Now, obviously, if the building has a negative cash flow, subject to further review, it likely is a very, very bad sign. So in this case, we're looking at, sort of what's the composition of this cash flow. Very positive here. Of course, the building had more revenues than expenses. So if we go back into the income statement, we can actually see that. So 147, 140 is the excess of revenues over expenses. And then we're basically seeing a similar number over here. So if we look at what's going on with cash flows, we can see that there's been a pretty large line item here of a negative cash flow. But in this case, the money is actually going into the restricted fund. The restricted fund is basically the reserve fund. So if we do a Control F here, and here we go. So you can see here that the restricted reserve fund is to be used exclusively for major repairs and replacements. So very healthy sign here that this building essentially increased its reserve fund by 50%, more or less, over the past year. Again, that's a very positive sign. So on the whole, if we were to look at these financials, there does not appear to be any major issues. The only thing that possibly looks a bit unusual is the water accounts payable, as discussed. But that aside, the building looks to be pretty healthy. The other thing we can look at again is the notes to the financial statements, specifically if there's anything related to the financials. This is interesting here. So looks like the condo has some sort of lease with a laundry provider, and the condo receives $3,600 from that. So that's not super relevant, but it might be interesting. Breaks out here the prepaid expenses. Also talks about other assets. We did look at that already. If we continue to go down, they have a note about income taxes. Again, not super important. And we've talked about the water and sewer. The other thing you might want to see is this note about future major repairs and replacements. So in this case, which is pretty common to see, the condominium has not conducted a study to determine the remaining useful lives of the components of common property. Basically, that means that the condo hasn't sort of had someone come and look at the roof, boiler, facade, things like that. But in general, that's pretty common. And the building, as we've seen, has a pretty healthy reserve fund. Plus, they did make substantial excess in terms of income versus expenses last year. So everything appears to be pretty healthy. Now, the final thing you may want to look at in the financial statement is notes about increases possibly to the common charges. In this case, there does appear to have been an increase, and so it has actually put that there in the notes of the financials. We will have another video available about analyzing a co-op's financial statement, so feel free to check that out. We'll put the link down below. And also, if you look below the video, you will see a link to this specific article, which goes through the major talking points that we did today about how to analyze a condo's financial statements. If you have any questions, feel free to leave us a comment below, and we wish you the best of luck with your real estate endeavors.